Ladies and gentlemen, good day and welcome to Aeroflex Industries Limited Q4 FY24 conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Asad Daud, Managing Director. Thank you, and over to you, sir.
Thank you so much. Good morning to everyone. I'm pleased to welcome you all to the Q4 and FY24 earnings call of Aeroflex Industries Limited. Joining me on the call are members from our management team and SGA, our investor relation advisor. I trust you all have had a chance to review our financial results and the investor presentation available on both the stock exchange platform and our company website. We have made a concentrated effort to address the investor inquiries and concerns, particularly regarding our capacity and our business operations. Our latest presentation comprehensively covers these aspects, and we are committed to maintaining transparency in this regard moving forward. Coming to our performance this quarter, despite the geopolitical tensions that is ongoing in the Middle East, which is affecting especially the shipping routes and also the export markets, we are delighted to report sustained strong demand for our products across both the traditional and the emerging industries. FY24 has been an exceptionally successful year for Aeroflex. It includes our debut on the stock exchange. We got listed on 31st of August 2023, marking a year of post-listing performance growth. Our production volume in this year has surged to 11.8 million meters, which is an increase of 32.18% on a year-on-year basis. We have maintained a capacity utilization rate at around 87.9%. One key aspect which is driving our growth is our relentless pursuit of excellence not only in the product development but also in our manufacturing processes. We have invested significantly in research and development to introduce cutting-edge products and new-age solutions to cater to the ever-evolving needs of our industry and our customers. By staying ahead of the curve, we are not only meeting but also exceeding the expectations from our customers, solidifying our position as the preferred partner for our customers in our industry. At Aeroflex, we provide the critical components to a diverse range of industries, which includes the aerospace, oil and gas, and in these industries, especially reliability, durability, and performance is of paramount importance. Looking ahead, we are excited to expand our footprint also in the new age industries such as solar, robotics, semiconductors, EV, and the aerospace industry. These sectors provide exciting opportunities for our company, and we are committed to leveraging our expertise and capabilities to serve these markets effectively. As of FY24, we have more than 2,300 SKUs across various product segments. Talking about our business segment-wise, so I say flexible hose. This segment has driven about 60% of our total revenue of FY24. Talking about assemblies and fittings, this has accounted for almost 73% of our total revenue, and this is the segment that will remain a focus area for the company. And we aim to enhance our value-added products in this segment to increase our overall product portfolio. Other segments such as braiding, interlock hoses, and composite hoses collectively contribute the rest of the FY24 revenue. I would also like to update everyone that we have recently acquired a company which is Hyde Air Engineering Private Limited. This marks a significant milestone in our journey. We acquired Hyde Air Engineering for a total consideration of 17.20 crores, and it was entirely funded via internal accruals. This acquisition will help us to provide end-to-end solution from hose and fittings to complete assemblies, thereby strengthening our overall value proposition and also enhancing the customer satisfaction. It will also help in the reduction of our product lead time. With this strategic move, we are also expanding our presence into key sectors such as railways, shipbuilding, and heavy industries, thereby gaining entry to a distinguished clientele base that includes the likes of Mazgaon Dockyard, SAIL, DHEL, JSW, ArcelorMittal, KSB Pumps, Tata Powers, and so on. Now talking about our capex that we have undertaken, during the quarter we have successfully concluded the expansion of 1 million meters, bringing our total capacity as of 31st March 2024 to 13.5 million meters per annum. The phase 2 of our capacity expansion is progressing as I discussed, and with no delays reported. In the phase 2, the company intends to increase the capacity to 16.5 million meters per annum. That is an additional 3 million meters, and the same should be completed by December of this year. In addition to the above, we are also completing the addition of 3 lines in the composite hoses production, and the same should be completed by Q2 of FY25. And lastly, the expansion of a new project of metal bellows that we have planned to undertake in 2 phases with a total capacity of 300,000 pieces annually at the end of phase 2, and as part of the phase 1 with a manufacturing capacity of 120,000 pieces per year, and the same is also slated to be completed by December of this year. Now looking ahead to this current financial year, we are highly optimistic about increasing our market presence in our biggest market, which is in North America, and also expanding and increasing our market share in the Middle Eastern region. We are confident in our capabilities to capitalize on the emerging opportunities and to drive sustainable growth for our company. Our goal is to sustain a growth momentum in the medium to long run, and for the upcoming years, we expect our margins to grow to the upwards of 25% and more. In line with our commitment to transparency and accountability, we continue to provide the regular updates on our performances and our strategic initiatives, ensuring that all our investors are well informed and confident in their investment decisions. Talking about our financial performance, our total income stood at rupees 79 crores for Q4 FY24. Our EBITDA came in at rupees 15 crores, and our EBITDA margins stood at 19.9%. And our profit after tax for this quarter came in at rupees 10 crores. And talking about the full year, which is FY24, our total income stood at rupees 317 crores. That is growth of 18% over last year. Our EBITDA came in at about 65 crores, which is a growth of 24% as compared to last year. Our EBITDA margins stood at 20.4%, and our PAT stood at rupees 41 crores, which is a growth of 38% on a year-on-year basis. Exports contributed 84% of our revenue, and it was mainly driven by North and South America and the European regions. I'm also happy to share with everyone that the board of directors has recommended a final dividend of 12.5%, which is 0.25 equity shares, 0.25 per equity share of which 2 each, subject to the approval of the shareholders at the ensuing AGM. We believe that a strong balance sheet and with zero debt in our company, it will help us to expand and capitalize on any opportunities arising from both traditional and new age industries, and it will also give us the financial leverage to consistently deliver high growth margin and profitability to create value for all our stakeholders. With this, I would like to conclude the presentation and open the floors for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, for FY24, if you could share the stainless steel tonnage that you consumed and what it was in terms of growth.
So we don't measure our sales in terms of kgs, because we are selling our products in the form of numbers and also in the form of meters, because that is the way we sell our products. So it is not on per kg or per ton basis. So hence, I will not be able to share that details with you, because some of our raw materials, they also come in the number of pieces and not in kgs.
Still for hoses, if you don't mind, and just share the tonnage number.
Like I said, we measure it in the form of meters. I can give you the data for meters.
That I have noted 11.8 million meters with 32% growth.
Yeah, that's also there in our presentation. You'll be able to see it in there. Because the reason why we do it in meters is because our production line, our entire operations, work on the basis of meter. Even our customers, when they buy it, they buy in the form of meters and not in the form of kgs. So hence the meters is a better indicator for us.
On the SS pricing side, if you could just tell us between 24 and 23, your stainless steel raw material pricing decline was how much?
About 20 to 25%.
22 to 25%, which means your hose growth will be some 7-8%, and balance growth came from the fitting side, because your fittings proportion would have increased versus last year.
Yeah, so fittings proportion has increased as compared to last year. So last year, the proportion of fittings to our overall sales was around 30%, 30 to 31%, and this year is about 34% almost. Okay.
On the current capacity, this 13.5 million meters.
Yes.
And last year, let's say last year's 11 million meter when you started the year, what is the optimum output on this 11 million meter? Because when you say meters, there is different SKU.
Right.
Smaller dia, medium dia, larger dia.
Right.
So, what can be the optimum revenue possible on this 13.5 million meter at the end of FY24 at the current steel prices?
So it depends a lot on the product mix. So because our products, so we are focusing our efforts more on the sales of assemblies, and that is where. So just to give you an idea that in Q4 of of FY24, almost 40% of our sales was from the assemblies section. So we are focusing and trying to increase our sales of the assembly. So even at, say, for example, 13.5 million meters, if we convert a majority of our sales into assemblies, you will see a significant jump in the top line, because the assembly product has both better top line and also better margins on the bottom side.
That I understood, but if it was hoses, then what is the output possibility?
So difficult to give like a number to it.
Okay, I'll ask you the other way around. Sir. Were you at optimum product mix last year?
So our product mix actually changes. The reason is because of, so we have more than 80 lines of machinery, and we manufacture right from a quarter inch to all the way up to 14 inches. And different machines are devoted to different. And the production capacity also for each machine is different. The output is different. The customer segment is different. So that is why to give you an exact number might not be possible.
Okay. And my last question is, sir, we have seen a continuous increase in the fitting proportion.
Correct.
You said last year was 30%, this year is 33%, and quarter 4 was 40%.
40%, correct.
And you have been always saying that fittings margins are significantly higher than the post margins.
Yeah.
Then why is it that the EBITDA margins haven't gone up?
So, if you see on a year-on-year basis, our EBITDA margins has increased by almost 75 basis points. So if you compare to the last quarter.
So I am looking at the last trailing 4 quarters. The quarter 1 was 19, quarter 2 is 21, quarter 3 is 19, and quarter 4 is also 19.
Yeah.
So all these quarters, the fitting share has moved from 30% to 40%. There's a 10% extra share, right?
Yes.
So,
there are 2 reasons. One is, if you see, our gross margins has increased, so that means our fittings have contributed at a better. But if you see, our selling and distribution expenses has also increased, significantly, which was not expected. Reason being is because of the Red Sea crisis. First, the availability of the containers was an issue in the last fortnight of December, and which also moved on to parts of January and some parts of February. Now the availability of containers has smoothened out, but even though the availability of containers has smoothened out, the prices of, or as in the freight cost has increased. Last year in FY23, the freight cost has actually come down, and even in the first part of FY24, the freight cost has come down. But because of this Red Sea issue, the freight cost has again gone up, like how it went up during the COVID times. Obviously, not at those levels, but at a significant level as compared to the last 2 quarters. So hence, if you see, our gross margins has increased, but our EBITDA margins has also increased, but obviously not up to that level because of the increase in the selling and distribution cost. Also, we are undertaking this new projects of bellows, of composite hose, of the expansion, and there are a few project related expenses which are also a part of the P&L, and hence if but that's a long term expenses, but obviously they affect the P&L, and hence if you see that you will see that the uptick in the EBITDA margins is not as high as what it should be, although it is in practical sense much higher.
Okay, sir. I'll come back if I have more questions. Thank you.
Sure. Thank you.
Thank you, sir. We have our next question from the line of Nilesh Doshi from Green Lantern Capital. Please go ahead.
Yeah. Thank you for taking my question. I had a couple of questions from my side. One is, I think you export more than to 80 countries, and I think your larger export is to US. Just explain me how the business works. It is like you appoint dealers, distributors over there, or it is directly B2B to the user?
So we have a mixed model where basically we have 3 sets of customers across the world. That is, one is the OEM that we supply directly to. The other is through distributors who we supply our product. They stock it in their warehouse and then they supply it to the assemblers, in their countries. And the third is that we supply to the assemblers and they then sell it in their own country. So this is the three. In the US, predominantly our sales comes from, one is OEM and the second is the assemblers who buy either the semi-finished product, which is the whole, or the final assembly from us, and they stock it in their warehouse and then they supply to their end customers. That is how the business works.
So which is the largest OEM or industry which buys, particularly in US from us? Is it refining, is it steel, or which are those?
So the two major industries that is buying from us is, one is oil and gas and refineries, and the second is firefighting.
In both the cases, you would have vendor qualification, their consultants, I believe.
So in firefighting, we are supplying directly to the OEM. In oil and gas, we are supplying to our assembler, and the assembler is registered in the OEM as a vendor, because they not only supply our products, but they have a entire basket of products that they supply to the the end OEMs.
So historically, if I look, these products were being probably imported by them from initially maybe from Europe or from China, and now we are seeing that shifting to India. So you have any comment that what is changing, or is it the price, or it is now? Yeah.
So actually, in our case, China is not a competitor. So basically, in the US, we are actually facing a competition. One is obviously from European manufacturers, but the other is also from US manufacturers. So there are a lot of manufacturers of this product in the US itself, because this is being a very critical component and used at very critical junctions, in the manufacturing plants. Hence, we face a lot of competition from actually made in America products. And that is why the time taken to shift a customer in our industry generally is longer. Price is not the first concern for these customers. It is about the quality of the product and the quality of our processes, our systems, our manufacturing capabilities, our entire production flow. So they look at all of these things first, and then it comes to pricing at a later stage. So hence, actually, we are competing with the US manufacturers and the European manufacturers.
So in terms of quality and the testing for whatever pressure you supply, you have all those facilities in India.
Yeah. So our lab is NABL certified. Also, we are in the process of completing the DSIR registration certification for our quality lab. So that means that we can also supply to the defense industry in India, and we have all the international certifications which are required for our products. So that is why if you see that right now the North America, especially the US, is actually our biggest market, in terms of a single country. And that is the reason why we have been able to penetrate the US market, is because of our quality of our products and the testing certificates and the testing lab that we have, and obviously our entire process. But yet there is a huge scope for growth in the US itself, because there are many companies, which are in many OEMs which are buying these products in larger quantities, but they are currently buying directly from manufacturers based in the US itself.
And in the export, largely does it come from the replacement demand, because this being a consumable, I would believe, then the new projects also?
Yes. So those existing customers, generally they have a replacement demand where they need to periodically replace this part or this flow system in their manufacturing process. And when they come up with an expansion or with a new facility or a new manufacturing unit, that time there is a new demand for a project order. So we define it as project orders and regular orders.
And typically, what is the lead time for supply for these kind of orders?
So, especially in case of a project or order, we generally take about 3 weeks to a month, unless it is something which is extremely different or something which is extremely new for us. That might take about 2 months. But generally, if it is something that we have already developed and we have the expertise, it takes about 3 to 4 weeks. And for regular orders, we have the capabilities to supply in even 2 to 3 weeks. Like from the date of order to dispatch, within 2 to 3 weeks, we can dispatch from our factory. And then obviously the lead time from India to the US.
And with what payment terms or through LC?
No, so generally in our industries, none of the customers or none of the OEMs, they work on LC basis. So US, although being the biggest market for us, is also a credit market. And sometimes what happens is, even if our payment terms is payment on delivery of the goods, but because of the transit time from India to US, and obviously because of this Red Sea, so the routes have changed and the transit time has become longer. So sometimes our payment comes, within 60 to 90 days also.
I see. And any working capital, in terms of performance guarantee or get blocked with the buyer?
That happens only in case of the Indian companies, especially some large ones, or especially in case of PSU tenders, where they have the requirement for a bank guarantee or for a performance guarantee. In case of large companies, in the foreign countries, we have to take a third-party product insurance.
Okay. Lastly, on the HVAC side and solar, last year, we had any revenue from this sector?
Yeah, so HVAC is a segment that we have, that we are building already. And solar is a segment that we have just recently started. We have supplied a couple of containers last year, and we are working on a new product for the solar industry. So in this year, our focus would be this year and the upcoming years. We will also develop a specific hose for the solar application.
So for solar would be rubber hoses, right?
Sorry to interrupt.
No, for solar.
I would request you to rejoin the queue as there are several participants waiting for their turn.
Sure.
I'll just complete the answer that for solar, it is the SS hose and there is a EPDM covering on top.
Thank you. We have our next question from the line of Mahesh Bendre from LIC Mutual Funds. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Sir, given the opportunities that you spoke about in international market, US and Europe, what kind of growth we are expecting over the next 2-3 years, and in the backdrop of recent acquisition as well. So if we add this together, what kind of volume growth we are anticipating?
Yes, I'm Mahesh. So yes, we acquired Hyder from the major objective of backward integration, where Hyder can manufacture a lot of the fittings that we are currently buying from outside, and it will also help us to first reduce our product lead time, in where we'll be able to deliver products faster and with a much better and with an even better quality to our customers. Also, it will help us to enter into new segments like railways and shipbuilding and heavy industries, where Hyder is already supplying its products. With regards to the target over the next 3 to 4 years, our target over the next 3 to 4 years is to grow at the same percentage as we have grown over the past 3 to 4 years, with a strong focus on both organic, inorganic, and also a focus on increasing our bottom line. So we want to enter into those product segments which have a much higher bottom line as compared to our existing products. So, ultimately going into higher value-added products.